Hey everyone, as I engage with investors across the US, I continue to hear a wide range of perspectives. Some see opportunity, but many have a very negative perception of the economy and the commercial real estate market. Investors' perspectives are of course influenced by the property types they concentrate on or geographic locations, but I think there's a pretty significant media-driven perception gap. The media remains focused on recession risk, a systemic banking crisis, inflation, rising interest rates, and the prospect of upcoming waves of commercial real estate distress. And I think the noise from the media is drowning out the actual hard numbers, the key performance indicators, and hence the perception gap. Don't get me wrong, there are some real challenges out there. The office market is disrupted, financing costs are a lot higher than they were a year ago, and asset prices are still recalibrating. I want to share some key metrics, data and contextualization that doesn't get as much airtime. I'll start with GDP. Economic growth was 2.1% last year and 1.1% annualized in the first quarter of 2023. That aligns with the consensus blue chip economic forecast for the full year of 2023, which is 1.2%. The media keeps focusing on an imminent recession, but the economy has generally been growing for the last 2 years, and the consensus blue chip economic forecasts for both 2023 and 2024 remain positive. Another key metric is job creation. The US has added jobs every month for the last 27 months, and there are 3 million more jobs in the US today than there were before the pandemic. In the first quarter of this year, the US added more than 1 million new jobs. Think about that. We keep hearing about an imminent recession, but we added more than 1 million jobs in the first 3 months of this year. And even though the media keeps highlighting major layoffs by big companies like Meta, Google, and Microsoft, the number of first-time unemployment claims remains in the mid-200,000 range, well below the 10-year pre-pandemic average of 312,000. So even though massive layoffs have dominated the news, they haven't translated to a material softening of the labor market. The unemployment rate has been locked in the mid-3% range for the last 13 months. That's at or near the record low of the last half century. Almost every recession in the last 70 years has been preceded by a 50 basis point rise in the trailing 3-month unemployment rate prior to the recession, and we just haven't seen that yet. The labor market is still very strong. So the labor market is not signaling an imminent recession. Another consideration that doesn't get mentioned much is that the 10-year Treasury has been hovering in the mid-3% range since mid-March. Looking back in time to before the global financial crisis, a 10-year Treasury rate in the mid-3% range was virtually unheard of. It would have been considered exceptionally low. Yes, we've all gotten used to the ultra-low interest rates of the last 10 years or so, but honestly, 3.5% is a really low interest rate. So if you set aside all the noise, all the speculation about recession risk and inflation and interest rates, and just look at the numbers, the economy is actually doing pretty well. And the same is true for most types of commercial real estate. If you compare the first quarter of 2023 vacancy and rent growth of the major property types with the 5-year pre-pandemic average, only office properties have weakened. The average first quarter apartment vacancy from 2016 to 2020 was 5%. In the first quarter of 2023, the average vacancy was 5.2%, just 20 basis points higher. But apartments had 6.4% rent growth over the last year, outpacing the 5-year pre-pandemic average of 4.4%. So even though apartment performance has softened, it's still comparable to how the sector was performing prior to the health crisis. Multi-tenant retail has improved. The 5-year average vacancy for multi-tenant retail before the health crisis was 5.9%, with rent growth of 2.7%. Comparatively, in the first quarter of this year, vacancy was 5.6% with 5.5% rent growth. So from both a vacancy and rent growth perspective, multi-tenant retail is outperforming. Industrial's also outperforming the pre-pandemic average with the most recent vacancy reading of 4% compared to the pre-pandemic 5-year average of 4.9%. Likewise, the industrial year-over-year rent growth was 16.6% in the first quarter of this year compared to just 5.8% in the 5 years prior to the pandemic. But as I mentioned earlier, office is looking pretty weak. The average office vacancy in the first quarter of 2023 was 16.8% compared to the pre-pandemic first quarter average vacancy of 13.1%. And the average annual rent growth for office between 2016 and 2020 was 3.1%, which is dramatically higher than the 0.7% office rent growth achieved in the last year. So while we keep hearing about the forces weighing on commercial real estate and how a huge wave of distress is imminent, if you compare the first quarter 2023 results against the 5-year average before the pandemic, only office is living up to the media hype. All the other property types are performing well. My point here is that there's a broad-based media-driven perception that commercial real estate and the economy as a whole faces a major reset. But when you look at the numbers, they tell a very different story. The sector is downshifting from a period of exceptional growth into a more normal operational climate, but that's not a massive reset. Yes, it's absolutely possible that the US could fall into a recession that drags commercial real estate down, but we've been hearing that story for a while now, and it hasn't shown up yet. By the same token, investors should remain vigilant. The market is softening and asset pricing is recalibrating, but don't get caught in the perception gap. Consider the hard numbers, and as always, think forward. Keep your eyes on the horizon.